Hey everyone, it's Graham Stephan here and welcome back to the channel. Today we're diving into the exciting world of Forex trading. Forex trading can be a powerful tool for building wealth, but it requires knowledge and skill. In this video, I'm partnering with Wally's Olan Rawaju. We'll explore 11 essential chart patterns. These patterns are like roadmaps for the market. Remember, trading involves risk. This video is for educational purposes only. Always do your own research. Now let's get started. Hit like and subscribe for more. Now let's get into it. Alright, let's kick things off with one of the most recognizable and reliable chart patterns out there, the head and shoulders. This pattern is a bearish signal, suggesting that an uptrend is about to reverse. Imagine this, the market is on an upswing, it forms a peak, that's the left shoulder, pulls back slightly, rallies to a higher peak, the head, dips again, then forms a final peak lower than the head, the right shoulder. See how it resembles a head and shoulders? That's how it got its name. The key here is the neckline, a trend line connecting the lows of the two shoulders. When the price breaks below this neckline, it's a strong indication that the downtrend is confirmed. Now you might be thinking, Graham, how reliable is this pattern? Well, when identified correctly, the head and shoulders pattern has a high success rate, but remember, no trading strategy is foolproof. It's crucial to consider other factors like trading volume and market sentiment to confirm your analysis. So how do you actually trade the head and shoulders pattern? Well, once you've identified the pattern and the neckline break, you can look for selling opportunities. Many traders enter a short position below the neckline, aiming to profit from the expected price decline. The distance between the head and the neckline can also give you an idea of the potential price target. It's like measuring the head of the giant you're about to slay in the market. But remember, risk management is key. Always use stop-loss orders to limit your potential losses in case the market moves against you. Remember, trading is a marathon, not a sprint. It's about making calculated decisions and managing your risk effectively. Don't let emotions cloud your judgment. Stick to your trading plan and let the market do its thing. Alright, moving on to another essential chart pattern, the double top. This one's a bearish reversal pattern signaling a potential shift from an uptrend to a downtrend. Picture this. The price rallies to a peak, pulls back, then rallies again to reach a similar peak level, forming two distinct tops, hence the name double top. These tops act like resistance levels, preventing the price from breaking higher. The key here is the neckline, a support level connecting the lows between the two tops. When the price breaks below this neckline with conviction, it's a strong signal that the bears are in control. Now don't confuse this with a simple pullback. In a double top pattern, the second peak often forms with weaker volume, indicating waning bullish momentum. This is a telltale sign that the sellers are gaining strength and preparing to take over. Now let's flip the script and talk about the bullish counterpart of the double top, the double bottom. As you might have guessed, this pattern signals a potential reversal from a downtrend to an uptrend. It looks like a W on the chart with two distinct bottoms forming at roughly the same price level. These bottoms act like support levels, preventing the price from falling further. The neckline in this case is a resistance level connecting the highs between the two bottoms. When the price breaks above this neckline with strong volume, it suggests that the bulls are back in action. Remember, trading is all about identifying patterns and capitalizing on them. The double top and double bottom patterns, when identified correctly, can provide excellent trading opportunities. But always remember to confirm your analysis with other indicators and manage your risk effectively. Let's talk about the rounding bottom pattern. Imagine a stock beaten down on a long downtrend. Then, it starts to slowly curve, forming the base. Look for increasing volume as the price climbs. Volume confirms the bullish momentum. Patience is key for juicy returns. So how do you actually trade a rounding bottom? Well, the key is to wait for a clear breakout above the neckline. Think of the neckline as the resistance level that's been holding the stock down. Once that neckline is decisively broken, It's like a coiled spring releasing, propelling the stock higher. Now you don't have to buy right at the breakout. In fact, it's often smarter to wait for a pullback. This gives you a chance to enter the trade at a better price with less risk. Look for the price to retest the neckline as support. If it holds, that's your signal to buy. Remember, not all rounding bottoms are created equal. Some are more symmetrical than others, and some have higher volume than others. The more textbook the pattern, the higher the probability of success. But don't just rely on the chart alone. Do your due diligence. Look into the fundamentals of the company. Is there a reason why the stock was beaten down in the first place? Has the underlying business improved? The more information you have, the better your trading decisions will be. Let's move on to another bullish chart pattern that's a favorite among traders, the cup and handle. Just like the name suggests, it literally looks like a cup with a handle. You've got the rounded bottom of the cup, followed by a slight downward drift that forms the handle. The cup itself represents a period of consolidation after an uptrend. The stock takes a breather, building up energy for the next leg higher. This is where institutions and smart money tend to accumulate shares, anticipating a breakout. Now the handle is where things get interesting. It's a short-term downtrend that typically forms over a few days or weeks. It's characterized by lower trading volume, indicating that the selling pressure is weakening. This is your signal that the bulls are still in control. The key takeaway here is that the cup and handle is a continuation pattern. It suggests that the previous uptrend is likely to resume, potentially with even more force. So, if you're looking for a signal to buy, the cup and handle is definitely one to watch out for. So, how do you actually trade the cup and handle? Well, just like with the rounding bottom, you want to wait for a breakout above the handle's resistance line. This is your signal that the bulls are back in charge and the stock is ready to run. Now here's a pro tip. Pay attention to the volume on the breakout. You want to see strong volume, confirming that there's real buying interest. If the breakout happens on low volume, it could be a false signal, and the stock might just fall back down. Another important factor is the depth of the handle. Ideally, you want the handle to be relatively shallow, forming a high-low within the top half of the cup. A shallow handle indicates less selling pressure and a higher probability of a successful breakout. Remember, the cup and handle is just a pattern, not a guarantee. It's crucial to combine it with other forms of analysis, such as technical indicators, market sentiment, and of course, fundamental analysis. The more data points you have, the better your trading decisions will be. Alright, let's dive into a chart pattern that's often misunderstood but incredibly powerful: wedges. Wedges are continuation patterns that can signal either a bullish or bearish move, depending on the context. They form when the price is squeezed between two converging trendlines, creating a triangle-like shape. Now here's where it gets interesting. Wedges can be either rising or falling. A rising wedge forms when the price makes higher highs and higher lows, but the upper trend line is steeper than the lower trend line. This indicates that buying pressure is weakening, and a reversal to the downside is likely. Conversely, a falling wedge forms when the price makes lower highs and lower lows, but the lower trend line is steeper than the upper trend line. This suggests that selling pressure is drying up, and a reversal to the upside is on the horizon. The key takeaway here is that wedges are all about identifying a shift in momentum. When you spot a wedge forming, it's a sign that the current trend is losing steam, and a reversal could be imminent. So how do you actually trade wedges? Wait for a breakout from the wedge pattern. This confirms a new trend. For a rising wedge, look for a breakout below the lower trend line. For a falling wedge, watch for a breakout above the upper trend line. Pay attention to the volume on the breakout. High volume confirms the move. Remember, wedges are just one piece of the puzzle. Combine them with other forms of analysis for a complete market picture. What's up everybody, it's Graham Stephan. Today we're diving into pennants and flags. These patterns show when the market takes a breather in a strong trend. Think of it like a roller coaster climbing up then hitting a flat section. That flat section is your pennant or flag. You'll see a tight consolidation forming a small symmetrical triangle or parallelogram. volume should decrease as the pattern forms. The breakout is where the magic happens. The price usually explodes in the direction of the original trend. Manage your risk and use proper position sizing. Always have a plan and stick to your rules. Now let's talk strategy. For trading pennants and flags, wait for breakout confirmation or anticipate it within the pattern. Use stop-loss orders to manage risk. Set stop-loss just below the low or above the high of the pattern. Pennants and flags help identify breakouts and ride momentum. Stay tuned for the next video on another powerful chart pattern. Alright everyone, in this chapter we're tackling another essential chart pattern that screams bullish potential, the ascending triangle. Now this pattern is all about identifying those moments where buyers are clearly in control, pushing the price higher and higher. Imagine this, you're looking at a chart, and you see the price bouncing between two trend lines. The bottom trend line is sloping upwards, while the top trend line is relatively flat, creating a triangle shape that points upwards. That, my friends, is your classic ascending triangle. What's happening here is that buyers are getting more and more confident, consistently pushing the price higher with each successive high. Meanwhile, sellers are getting squeezed, trapped between that flat resistance level and the rising support. It's like a pressure cooker just waiting to explode, and explode it does. When the price finally breaks above that flat resistance line, it usually takes off like a rocket. This is because all those eager buyers who were waiting on the sidelines jump in, creating a surge in demand that sends the price soaring. Now let's talk about how to capitalize on this bullish pattern. The key with ascending triangles is to wait for that breakout confirmation. Don't get too excited and jump in too early. Remember, patience is key in trading. Once the price breaks above the top trend line with strong volume, that's your signal to enter a long position. This breakout is often accompanied by a surge in volume, confirming that the buyers are in control. Remember, volume is your friend. As for your profit target, a good rule of thumb is to measure the height of the triangle from its base to its highest point, and project that distance upwards from the breakout point. This gives you a realistic target for your trade. Of course, risk management is crucial with any trading strategy. Always set a stop-loss order just below the lower trend line of the triangle. This will help you limit your losses if the breakout fails, or the market reverses unexpectedly. Hey everyone, Graham here, and today we're flipping the script and diving into a bearish chart pattern that's all about spotting potential downtrends, the descending triangle. Now this pattern is essentially the opposite of the ascending triangle, and it's a clear sign that sellers are gaining the upper hand. Imagine this, you're analyzing a chart, and you see the price action forming a triangle shape, but this time it's pointing downwards. The top trend line is sloping downwards, while the bottom trend line is relatively flat. That's your classic descending triangle. What's happening here is that sellers are getting more and more aggressive, consistently pushing the price lower with each successive low. Meanwhile, buyers are getting trapped, stuck between that flat support level and the falling resistance. It's like a game of tug-of-war, and the sellers are winning. Now, just like with the ascending triangle, the real action happens when the price breaks out of the pattern. But in this case, we're looking for a breakdown below the lower trend line, signaling a potential downtrend. When the price breaks down from a descending triangle, it's often accompanied by a surge in volume, indicating that sellers are in control and pushing the price lower. This is your signal to enter a short position or exit any existing long positions. To determine your profit target, measure the height of the triangle from its base to its lowest point, and project that distance downwards from the breakdown point. This gives you a realistic target for your trade, and, as always, risk management is crucial. Set a stop-loss order just above the upper trend line of the triangle. This will help you limit your losses if the breakdown fails or the market unexpectedly reverses. Let's dive into a crucial chart pattern, the symmetrical triangle. It's like the calm before the storm. Prices bounce between converging trend lines, forming a triangle. This pattern screams market indecision. Buyers push higher, sellers push back, creating lower highs, buyers push up from lower lows. This back and forth forms the triangle. Indecision can't last forever. Eventually, something's gotta give. It's like a coiled spring ready to release. That's the beauty of technical analysis. We're reading market signals and understanding probabilities. Symmetrical triangles often lead to significant price moves. So, how do you actually trade a symmetrical triangle? Well, patience is key here. You don't want to jump the gun before the breakout happens. Instead, wait for a decisive break above the upper trend line for a potential long signal, or a break below the lower trend line for a potential short signal. Remember, volume is your friend. A breakout on strong volume is a much more reliable signal than a weak low-volume break. It shows conviction and suggests that the move has legs. So, always keep an eye on that volume indicator. Now, once you've identified a confirmed breakout, it's time to manage your risk. A good rule of thumb is to place your stop-loss order just outside of the triangle pattern, on the opposite side of the breakout. This helps to protect your capital in case the breakout turns out to be a false signal. And finally, remember that no trading strategy is foolproof. While symmetrical triangles can be powerful tools for identifying potential breakouts, it's crucial to combine them with other indicators like moving averages or oscillators to confirm your signals and improve your odds of success in the market. Alright guys, let's talk about the rectangle pattern. Rectangles represent market consolidation with prices bouncing between support and resistance. Think of it like a boxer pacing in the ring, conserving energy. The market is gathering momentum for the next big move. It provides clear entry and exit points. Wait for breakout confirmation with high volume. A breakout above resistance signals a buy. Below support suggests a sell. Now, let's talk about how to actually trade the rectangle pattern. The key here is patience. You don't want to jump the gun and enter a trade before the breakout is confirmed. Remember, the market can stay in this consolidation phase for a while, testing your patience and discipline. Once you see the price breaking out with strong volume, that's your cue to enter the trade. Your entry point would ideally be slightly above the resistance level for a buy, or slightly below the support level for a sell. This ensures you're getting in at a favorable price and minimizes your risk. Remember, risk management is crucial in any trade. With the rectangle pattern, you can set your stop-loss order just outside the opposite side of the rectangle. For example, if you're buying on a breakout above resistance, your stop-loss would be placed slightly below the support level. Finally, remember that rectangles can form in both uptrends and downtrends. An ascending rectangle usually signals a continuation of the uptrend, while a descending rectangle often precedes a further drop. So always pay close attention to the overall market context before placing your trades. Today we're diving into a pattern that screams reversal, the triple top and its bearish counterpart, the triple bottom. These patterns are your early warning signs that a trend might be about to change direction, and understanding them can help you avoid getting caught on the wrong side of the market. Let's start with the triple top. Picture this: the price of an asset climbs to a certain level, pulls back slightly, then rallies back up to that same level again. It tries to break through this resistance level a third time but fails, creating three peaks at roughly the same price point. This, my friends, is a classic triple top pattern. Now, why is this significant? Well, this repeated failure to break through the resistance level indicates that the sellers are stepping in with force, pushing the price back down. It's like a tug of war where the bears are finally overpowering the bulls. The triple top pattern is a strong bearish signal, suggesting that the uptrend is losing steam and a potential reversal is on the horizon. Keep your eyes peeled for this pattern, especially after a prolonged uptrend, as it could save you from some hefty losses. Now, let's flip the script and talk about the bullish counterpart of the triple top, the triple bottom. As you might have guessed, it's essentially the same pattern but inverted, forming at the bottom of a downtrend. In this case, the price drops to a certain support level, bounces back up slightly, then drops back down to that same level again, creating a trough. It repeats this process 2 more times, forming 3 bottoms at roughly the same price level. Just like the triple top, this repeated failure to break below the support level indicates that buyers are stepping in with force, preventing the price from dropping further. It's a signal that the downtrend is losing momentum, and a potential reversal to the upside is brewing. Now here's the thing, both triple tops and bottoms are powerful reversal patterns, but remember, no pattern is foolproof. It's crucial to look for confirmation from other indicators, like volume or momentum oscillators, before making any trading decisions. And there you have it, guys. We've covered a ton of ground in this video series, from basic chart patterns like the head and shoulders to more complex formations like the triple top and bottom. Remember, mastering these patterns takes time and practice, so don't get discouraged if you don't get it all at once. The key is to study these patterns, practice identifying them on historical charts, and start incorporating them into your trading strategy. The more you practice, the more confident you'll become in spotting these patterns and using them to your advantage. Now I want to hear from you guys. Which chart pattern do you find the most interesting or profitable? Let me know in the comments below, and let's get a discussion going. Don't forget to smash that like button, subscribe to the channel for more awesome content, and hit that notification bell so you never miss an upload. Until next time, happy trading.